Greetings, and welcome back to the podcast. This episode, we are joined by Mr. Jason Landau, Managing Director, Portfolio Manager, and Head of the Investment Team at Waratah Capital Advisors, an alternative asset management firm that has grown from approximately $35 million to over $4 billion under management since its inception in 2010. Mr. Landau joined Waratah Capital Advisors in 2010 and is the lead portfolio manager on the Waratah Alternative ESG Fund and co-portfolio manager on Waratah 1 and Waratah 1X. Prior to Waratah, Mr. Landau worked at TD Securities as an associate in investment banking and equity capital markets. Mr. Landau received an honors business administration degree from the Richard Ivey School of Business at the University of Western Ontario. Among other things, we discuss how Waratah tames volatility for clients, compounding at 10% annually, and the investment case for natural gas. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This podcast is sponsored by headracingcanada.com. In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is now offering free shipping on European factory performance ski gear. By passing brick-and-mortar savings on to customers, headracingcanada.com offers the lowest pricing available in Canada. Check out headracingcanada.com for more info and get your new ski gear for the season. Good afternoon, Mr. Jason Landau. Thank you very much for doing this.
No problem. Thanks for having me.
I appreciate your time.
Great.
Not many people would venture out in minus 20 to a obscure but growing podcast. So
Happy to be here.
For the listener, you are the managing director / portfolio manager / head of investment team at Waratah Capital. But for anyone that is listening, what is Waratah Capital?
Waratah Capital Advisors is a investment management firm based in Toronto. We manage just over $4 billion now, spread across 7 different strategies, predominantly long-short. Been in business since 2010, and the firm's grown pretty rapidly since then. All fundamental investing, where we're looking to pick long-term compounders and hedge out risk along the way.
Would you describe it as a hedge fund?
Yes, you're technically a hedge fund. I would say that term is often, what's the right way to phrase it? Often negatively perceived. And I would say the goal of a hedge fund is to minimize risk. So when there's drawdowns in markets, when markets go down, our expectation and our goal is to limit those drawdowns for our personal investments within the funds. Or say the broad fund should have limited drawdown over that period of time.
For today's conversation, I thought to give it structure, we might loosely base it around the hedge fund world and maybe some current events and / relevant topics in investing.
Yeah.
But to get back to the beginning, how did you get into investing? Maybe
good question.
A little bit.
I grew up in Toronto, just north of the city, and followed my girlfriend at the time to Western, went to business school. I thought I wanted to go to investment banking, come out, do private equity, and I thought that would be it. Become a partner of a private equity firm, and I went a portion of the way down that path. I did business school, came out, did investment banking for 4 years, and quickly learned in investment banking that I didn't really like it, and nor did I want to go down the private equity road. What I like doing is investing, going home, reading annual reports, thinking about stocks, thinking about why stocks move certain ways, and really sort of deploying my own money into stock markets and understanding how that works. And I graduated in 2006, started thinking about public markets in, I would say 2007, and then 2008 sort of reared its head and sort of derailed that a bit. In 2009, things got better. And I would say 2010, the 2 founders of our firm left their respective firms and started Waratah. And they left each of their firms in January. The funds launched in July. And I started Waratah in September of 2010. I was the 6th employee. There was $35 million of AUM day one when I started. And the team's grown, pretty meaningfully since that time. We're 55 people today and sort of growing. So that's my background, how I did it, but total 180 to what I thought I would be doing at 18 years old.
How would you describe yourself as a classic value investor, sort of a Ben Graham / maybe Walter Schloss, or growth investor along the lines of Phil Fisher, or a 100% active hedgy? How would you describe yourself?
Yeah, good question. So I'm not a value guy. That's for sure. There's a funny story. When I went for my, Brad Dunkley, one of our founders, during the interview process, he said, let's go for a walk. I remember being mid-20s and he asked me, what are the 3 most important things you look for in a stock? And coming to investment banking, my number one answer was valuation. Mm-hmm. And he said, now 17th on my list. And you quickly learn that positive attributes of a business from a qualitative perspective, or how they invest their capital and how they generate returns on that capital, are far more important than any valuation metric that's there in the public market. So I would say we are growth investors. We don't necessarily chase high multiple crazy stocks, but the preference generally is to own higher multiple stocks because they're expensive for a reason. There's been history that they've compounded capital at exceedingly high rates relative to peers or competitors for a long period of time. And that sort of is the name of the game. And, the market's really smart. They figure out, why are things expensive? They're expensive for a reason. Really, they're cheap for a reason also. So it bifurcates pretty quickly.
To create a symmetry of risk with your clients, do you feel it is important to invest your own money, to bleed, so to speak, if they bleed?
Oh, 100%. I would say I have 90% of my personal net worth invested in the funds, and you got to eat your own cooking. There's no two ways about it. So, we pride ourselves that during COVID, we navigated markets quite well. And you keep thinking to yourself, our benchmark is the 50/50 of the S&P 500 and the TSX. That had a drawdown. So peak to trough from just probably the end of January till March 23rd was the low. It was 35%. And I don't think anybody wants to open up their statements and see a 35% loss in their hard-earned savings. So we were able to do meaningfully better than that. And I point to the positive side of the equation during that period of the drawdown. But that's really the name of the game. So exactly that we have a lot of founder employee capital in our funds today. And I think it's wildly important to be invested alongside clients.
That's a bit of intro on you and the business.
Yeah.
To touch on some investing themes. One thing I have been thinking about lately is before we get into maybe the mechanics of the fund and performance and whatnot, is something really macro. And it's kind of like talking about the weather, but the recession, the last 18 months, people have been calling for a recession. So where's the recession? I'm
of two minds. Okay. I'm thinking we went through 0809, we came out, we had a really big economic cycle, and that economic cycle largely lasted for 13 or 14 years, if you want to call it. Whether or not, there's debate during the COVID time period. Was it a recession? Wasn't. Technically, I think we had 2 quarters of negative GDP growth over that period of time. Some deem that to be a recession, but all purposes, let's say we didn't have a recession period of time. The logical person would say, well, we're due. And then the counter is you go live your day-to-day life. And at least in Toronto, restaurants are full and it's hard to get a reservation. And I remember I was in New York, I think in November 2022, just something, markets were down, US markets were down double digits, and NASDAQ was down 30% in 2022. And there was a Salesforce.com team at a restaurant on a Tuesday night celebrating with big bottles of champagne and sparklers and all that stuff, going crazy. And you just don't see it. And you can't get tradespeople at your house. You can't build a fence in your backyard for anything reasonable. It just doesn't exist. So Main Street is sort of saying one thing a bit, and Wall Street's expectations are saying something different. And it's marrying the two. So I would say we're starting to see signs of it in Main Street, of what the interest rate bumps over the last 18 months have done to people. Like housing market has ground to a halt. We haven't seen a material fall in prices, but transaction volumes have really slowed here. So we're starting to see some trickle effect, but I agree with you. The Great Recession, or the one that's looming, is still looming.
A couple of years now.
Exactly.
So how does that impact Waratah? Do you think about investing differently, or do you look at bottom up sort of style, or?
Yeah, we always sort of think bottom up from a stock selection perspective. There may be some theme that we really like that we want to play long term, whether it's nuclear or we spent a bunch of time on sort of decarbonization, but the second or third derivative of it. So if and when electric vehicles take off, the grid has to get invested in. Well, who makes the poles to put up the equipment? And it's, Stella Jones. It's sort of, that's our line of thinking. We came into 2023 quite bearish and quite conservative. So maybe we'll get into it shortly, but one of the tools in our toolkit for managing a fund is your net exposure. So your long dollars, your long stocks, and your short stocks. If you take the sum of those, it's your net exposure. So, some of our funds were running quite low net exposure relative to history that we typically run, and certainly relative to the markets, because the market's $100 long. So I'd say the massive run up in 2023 caught us by surprise. We thought that, recession was gonna come. It didn't. And now sort of reevaluate the Fed's changing course and what that means for stocks and businesses as we go forward.
On the subject of performance, I'm thinking about it recently, and the concept of the hedge fund versus just investing in an index fund, for instance. On one end, you have the hedge funds who will say you need to manage volatility. That's the point. On the other hand, those people on the other side of the argument, it's buy an index fund and hold for 10 years and you're guaranteed to outperform. How do you think about that in terms of advising clients?
We like delivering a smooth ride. And I think that's where our value add is. Whether it's, you should make money by owning the S&P 500 for 10 or 20 years. And you could truly call that going to the beach trade. If you want to open up your statements or your online account and look at it every day, there may be some, white faces over the period of 10 years. I think the goal for us is to perform exceptionally well when you think about risk-adjusted returns, and just ensuring that volatility is masked. There may be some older investors that we have that don't want to have a 35% drawdown like people saw during COVID, and stripping out that volatility over periods of time. So I think, needless to say, 100% of everyone's investment dollars doesn't have to be allocated into one bucket. So there's a portion that's self-managed that owns S&P 500 for a decade or 2 decades. And there's a portion that's allocated to a, actively managed fund like ourselves that can really sort of smooth out that volatility. And I would say this, doing 10% a year for 7 years doubles your money.
It's pretty good.
That's pretty good. That would be our hope and goal there. And I think there are certain products, that we have that have proven that.
Maybe just to explain it simply to somebody who is listening, the idea behind a hedge fund is that you actively manage it daily or weekly or yearly, and the idea is to reduce volatility for the investor so that on any given quarter, you open up your statement and it's not down by 35%, versus indexing, where if you buy the index, it could be down 35% on the quarter and you have to cash out that day. Would that be a good summary?
Yes, that's it in a nutshell. And the way I think about it is if the market's down 10%, can I be down 2%? And if the market's up 10%, can I be up 5 or 6%? And that is how you string it together, and you really sort of compound wealth over the long term.
Waratah's grown, but how many people realize that?
I think a lot of people. Here's a great example: is last year, 2 years ago now, getting my dates mixed up. 2022, markets were down fairly meaningfully. I think S&P 500 was down, more than double digits. I think high teens, if memory serves correct. Nasdaq was down 32%. TSX was down mid-single digits, and most of our funds were positive. And that is it. It's just the line I like to say is, I don't want to dig myself a big hole that when times are good, I got to dig myself out of that hole to start making money again. So it's protect capital when drawdowns happen, and it's contribute and participate in rallies of markets when times are good.
Easy money. The last 15 years, interest rates have been historically low. How has that impacted Waratah, and how do you guys think about that in terms of performance?
So there's two answers here. One is, I don't think any investor knew how good it was for that period of time. Everybody should have taken much more advantage of so, what it did, it inflated asset prices everywhere. And 2021 was the poster child for it. So there's that angle. And the other angle that helps, not to get too technical here, but when you short a stock, we sell the stock and then we have to buy back later. When you sell the stock today, you receive cash for it. That cash sits on our balance sheet. So in a period of zero interest rates, we made $0 or return or interest from that cash sitting on our balance sheet. I'll tell you one point in Waratah's history, we actually had to pay banks to hold that cash. That's completely flipped today. So we're now, whether it's 4 to 5% return you can earn on the proceeds of your shorts or excess cash that you may not have invested fully in the market is a clear advantage. The other thing I would say, what hurt us to some degree in the last 15 years of the free money era is as valuations got crazy, because when you build a DCF and your terminal value is based on a risk-free rate, and apparently when your risk-free rate is zero, everything's worth infinity. It was hard to short stocks at a period of time when valuation didn't matter. There was no cash flow stream. And, on the plane on the way out here, I was reading a research report on Roku. It's not that popular in Canada, but it is in the US. The stick that you watch Netflix and Disney Plus, and they have their own channel. Research analysts built a DCF, and the DCF was $5.64, and the stock's $90. And that's sort of like a great example of, it's not a real business with real cash flows. Maybe one day they can turn into it. But as rates have climbed higher here, there's been a greater emphasis on real businesses with real cash flow streams, which has made the short side of the portfolio, I want to call it easier, but certainly one with many more opportunities to it.
On the flip side, when the risk-free rate goes up, it makes it harder to justify your value proposition to investors. How do you think about it from that perspective?
Yeah, throughout all of 2023, we were constantly asked the question, I could open up a high interest savings account and earn 4 or 5%. Why should I invest with you? My answer was always that equity markets will turn, and you want to have capital involved in the market that can see those opportunities and participate. And no greater example than November and December last year, when the Fed pivot happened, market screamed higher, and having equity exposure is what you wanted. My wife also works in the industry. Her rule of thumb is if you need your money for the next 2 years, keep it in cash, but otherwise you should be invested.
Yeah. Dividends versus buybacks. When you're investing, do you have a preference when you're looking at a business, and how do you think about that?
Yes, I have a clear preference, and I don't get special dividends. I can't, it's like something my brain won't make it work. And I have a clear bias towards buybacks. And I've listed out in a few ways. I should say, if you're thinking about the energy world, if I was a CEO, and I say this to all CEOs, it's really easy to run your business on a spreadsheet. It's really hard to run it in real life. So take it all with a grain of salt. But the flow of capital, if you will, I'd start a cash flow. I'd run a business and capitalize all my assets. So it's CapEx. There's a regular dividend, which the market will value for. And then it's buybacks. I don't believe specials should be part of the equation. And there's a few reasons. You permanently impact your business by retiring shares. Cash flow per share naturally goes higher. You can raise your dividend, common dividend, regular dividend every year by the business not even paying out the same dollars because it's just less shares outstanding. And then there's the other component here, which is, well, two things I'd say. There's tax. Eligible dividends are, in my lovely hometown province of Ontario, it's 39% tax. And starting in 2024 is a buyback tax federally of 2%. I kind of think I'd rather have 98-cent dollars than 61-cent dollars. And this is sort of the underlying theme that we always think about too. If a company is not buying back its shares, why should we? Why should we be an owner of a stock when the company doesn't believe in the prospects of a stock? And then you can get into a lot of companies have said, there's a certain NAV that we won't tell you in which we're going to buy stock above or below. And it's just, there's so many errors and assumptions that go into NAVs. What discount rate are you using? What oil price are you using? What gas price are you using? How are you capitalizing your assets on a go forward 5-year basis? Is there an opportunity? It's sort of, do you think there's an opportunity in your business over the next 5 years? And if so, if you think you can grow your net asset value over a period of time, then you should be buying your stock today. And that's how we view it. It seems natural to me that retiring shares and impacting business permanently into the future is way better off than just sending money out the door. And maybe one more thing I'd say is a lot of the businesses in Calgary have committed to a certain percentage of free cash leaving the business. So it's not as if that dollars is going to stay in the business and can be capitalized and invested within assets. It's not, it's leaving. Mm-hmm. So if it's leaving, why not make a permanent impact?
The worry on the flip side of that is, I guess, from the common investors that although you canceled, say hypothetically, you cancel 100 shares this month, you issued yourself 200 more the next month. And there's always that worry, and maybe the transparency isn't there. Do you have to keep a close eye to make sure your investments are being managed correctly from that perspective?
Yeah, I think so. Issuing equity, we think a lot about how companies treat their capital. If you're a constant issuer of equity and your shares outstanding just naturally grows over time, you don't have that, thought process and belief. And it's sort of you sometimes lack an owner's mentality. You may be in it for the paycheck as opposed to the share price. Where I think there's been, a lack of equity issuance in energy and oil and gas over the last number of years. So by and large, the shares outstanding have shrunk over the period of time, but it's certainly something to be mindful of. I'll tell you, when we run our math, it's, fully diluted shares outstanding. It's, the only way to build valuation work. But yeah, it's certainly something we're cognizant of, but the power of retiring 10% of your outstanding every year should far outweigh any option issuance that happens.
The other, I guess, component is that some big investors like to see the special on the income statement on a monthly basis, and that maybe they influence the decisions of management teams, big capital providers. Do you see it that way, or is it just math?
To me, it's math. And
there's no influence.
And I can't get the math to work by running a special dividend. I can't understand how that creates value for the business over a period of 5 years. And just run the math where you hold the multiple constant today of what it is from 5 years, and you calculate cash flow per share, and it naturally works in your favor. And it's juice to the trade when you fully tax it. I think the investors who like special dividends are ones who are non-taxable. And there's an advantage. So whether or not they can recycle that capital into other investments, or they choose to buy more shares, that's entirely up to them. But for the layman who doesn't have their investments all hidden in their RSP, it's pretty clear to us.
The psychology of investing, buying low, selling high. As a hedge fund, you're pretty active, so maybe there isn't as much of that, but does it play a big role in the way you run Waratah?
Ideally, we are buying low and selling high. And well, number one is our hit rate's our batting average is not 1,000. That's for sure. If you're a really good investor, I think you're getting 6 out of 10 trades right. And if you're doing it really right, you're weighting your rights way more than your wrongs. And that's how you really generate the return. What we are very cognizant of is understanding the other side to the story when we have a position on. If we own a stock, we like it, it's on the long side of the portfolio, we want to clearly understand what the bear case is. And it's sometimes you're right, and sometimes the bears got it right. There's a great line of Brad's, I'll steal it, is there's no magic in zero, which is if you're long a stock and the bears prove you right and the short thesis is proven right, you can put it on the other side of the ledger pretty easily. Vice versa. We've been short stocks and we've been proven wrong, and it ends up on the long side of the portfolio. That's why I encourage every management team to meet with people who short stocks. There's 2 tickets embedded in that meeting. There's a buy ticket to get to zero. And there's a buy ticket to get from zero to a big long position. And we're very happy to be long anything and everything when the fundamentals prove that to be accurate.
On the concept of shorting, it's controversial, but I guess from your perspective, it's a healthy component of a market.
For sure. And you think when drawdowns happen in markets, and if everyone just owned stocks, they'd be sellers. Mm-hmm. But if people are short stocks, they have to cover, which is buying back the shares that you shorted. We're naturally there in the market to offset large drawdowns. It's very rarely, I would say, part of the misnomer about hedge funds and short sellers, and we're not this evil crew hoping, stocks go to zero. Maybe we think a stock's overvalued, and maybe by and large, we're just trying to hedge out risk. Maybe we own an oil producer on the long side of the portfolio, and the short side, we put one on that we just think appreciates less. So I think there truly is a role in markets for short sellers. And you think back to 2009 when they banned short selling on financial stocks. It didn't do anything. It didn't help facilitate markets properly. And I'll give you a great story. It was actually, I'm out here for the Peters Lake Louise conference. I think I've come every year for probably 10 or 12 years. And one year they asked me to sit on the panel in Lake Louise. And it was myself, gentleman who runs long only manager for capital, and a portfolio manager from one of the large pension funds who runs private equity capital. And my little presentation was on misconceptions of a hedge fund. And when I told this story, I said, we were short Trican and we lost 35% on it one year, but we were long Canyon and we made 270% on it. And that trade to us is fantastic. We hedged out risk along the way. We took out specific events. And that's what we're trying to do. And the CEO at Canyon was actually in the audience when I said that. And he was in the back row and he stood up with a big fist in the air. He said, yeah.
Although it's been difficult with, like we said, the markets have been so strong the last 15 years. And I was reading an article, I don't know who it was, but one of the big short funds recently closed. You know what that is in States?
It might have been Jim Chanos's
I don't know.
firm.
I don't remember. But anyways, it's been...
a lot of large hedge funds have given back external capital and converted it to family offices.
The short strike, it's just been tough the last 15 years.
It has for sure.
The bull market.
Yeah. Outside of 2 months during COVID.
Yeah.
That was sort of the only period in time which shorts really outperformed.
The fund invests in energy.
Yeah.
How much of the fund is involved in energy?
It obviously varies quite a bit. I don't even know what benchmarks are from a weight perspective. I mean, on a sector basis, or the TSX SP 500. But I think memory serves correct. SP is 5 or 6% is energy. TSX is sort of high teens, if not 20%. We've roughly had 20-ish% of our funds in energy. It ebbs and flows over periods of times. We think, now it's pretty attractive. Balance sheets have been right-sized. Finally, as a Canadian, you can say that a couple big, large infrastructure projects are on the horizon here. We may actually get it over the finish line. Oil and gas demand are here for the future. It doesn't look like it's going away anytime soon. So it sets up quite well. With that said, when I speak to 20% of the fund in our market neutral fund, that would be have both long and shorts. So think about the quick math. We may be long $12 and short $9 of the fund. So our net exposure, 12 minus 9 is 3, but our gross exposure, which is the longs plus shorts, would be 21. So it's $21 of energy equities invested in the market, but we only have $3 of net exposure.
Where is that in comparison to the last 5 years? Is it grown? Is the money coming?
Yeah, during COVID, obviously shrank a bit, but there were some pretty big opportunities. By and large, energy's been something that we've understood over a period of time. I would say that maybe the percentage of investment in energy shrank in the last few years of sort of the last decade, you call it, 18, 19-ish. It was a struggle to generate, pretty meaningful returns, but we've ramped it up quite meaningfully coming out of COVID here.
Do you see that as a trend coming from Toronto or out east, or are you guys unique, or is the capital coming back? Or
I think we are unique. I think,
when you look at Bay Street, do you see others getting back in energy, or is it?
There's some, and I think there's some big firms that are, have constant allocations to it. Some of the large, bank-owned asset managers, some of the private ones come and go. I do think the pensions have a, pretty meaningful, consistent exposure, but I'd hate to speak out of tune on other people's portfolios.
In terms of energy, some people kind of find it as a oil trade or a natural gas trade. Do you have a preference on one commodity versus the other right now? Are you seeing opportunity in natural gas versus oil, or vice versa?
Yeah, I think we'd be gas over oil today for sure. And it's, notwithstanding the minus 25 temperature that it was walking over here, it is, I think there's a big opportunity. If you think about what's in store for 2025, both Canada and the US, that, we are of the belief, and we've done a bunch of work here, that LNG Canada comes on early. And it wouldn't shock me if this year was the year, being 2024. So to have 10% of demand come out of this basin is pretty powerful from one project. And then if you think about the US, over the next 4 or 5 years, LNG demand will go from 12 BCF to 25 BCF, like 100% increase in the span of 4 or 5 years, which is a pretty meaningful component here. And then you think about it, today EQT, pre-Chesapeake and Southwestern merger, EQT is the largest natural gas producer in the US. And they say they need $3.50 gas to earn a 10% return in their portfolio. Well, gas I didn't look at the 24 strip today in the US, but it's sub $3. And I don't know how you make money. So when you think about the industrial demand, the residential heating demand, some would call it the globalization of gas. And there's beliefs that Europe is actually would be the price setter of gas into the future, and just take the $6 transport charge that it takes, or transport plus liquefaction, and you get a North American price. Let's not forget the EU labeled gas as a green investment, and it's this bridge fuel that gets us into the future. All the while, we have a natural demand pull that's coming with these LNG projects. That's our take. On the oil side, I'd say, when OPEC is restricting or curtailing as much volume as they are, it doesn't give you the warm and fuzzies of a great looking market. That volume has to come back. I remember all too well what happened in February and March of 2020, even pre, great COVID. This is the price war that ensued, and all these boats showed up on the shores in the US, and it feels like OPEC and Saudis wanted to teach everyone in North America a lesson, and they did it. So the ability for them to do that as US shale production, again, has exceeded expectations in 2023. So that's always a bit of my fear in the back of my mind here. It seems like everyone's playing nice in the sandbox together. But if we would say is, demand's coming on the gas side, and we're there, the part, I asked one of my colleagues last week, I said, the part that scares me the most on the gas trade is it too easy? Mm-hmm. Is it too consensus? And I think people know that the demand pull's coming. The real crux of it is when. And we're happy to be there today. Maybe we're a bit early, but I do know that $2.50 gas doesn't make anybody money. Yeah. So, capital should come out of the system here, and it should right size.
The flip side of that is LNG, another place to sell your gas, is great for the economy in general. But the worry is that because natural gas is a commodity, you'll just get this classic supply and demand where supply ramps up and that the commodity just falls again. Does that worry you?
Yes. Yes. With the backdrop of, we're not saying $9 gas again.
Okay.
We're saying $4.50 gas.
Right.
And when the largest producer that's got really good rock in the Marcellus tells you that they need $3.50 gas to earn a 10% rate of return, I bet you they're quoting half cycle. Then bake in corporate costs. And one of your great podcast participants, Steve Lark, taught me a really good one-liner. Take whatever half cycle and less 30% to get to what full cycle economics are. And, you got to pay people. You got to have an office. You got to, all the things related to running a business. And eventually the free money sort of goes away.
Yes. Unless you're a low-cost producer like Tourmaline or Pine Cliff, it's really hard.
Yeah, for sure.
But that being said, another place to sell your gas is good. Like the LNG it's great.
I think Tourmaline will have gained $1 billion in cash flow in 2023 from selling volumes out of Cheniere's facilities. Like, that's spectacular to think about what that marketing team delivered, like finding the pipe volume to get from Alberta all the way down to the Gulf and taking it. It's fantastic.
How do you balance activity with waiting for truly good investments?
Yeah. One of the great lines that we have is, sometimes you do all your work and it's just not the right time.
Mm-hmm.
And put the file at the corner of your desk. It's really, really hard. And one of the other guys in the office says, you're going to like it, so just buy it. Timing is really it. As an investor, when you do your work and you get really excited on something, you're often probably overly excited relative to what you should be. We're trying to, you try to wade into trades, may buy a small position, stock pulls back, maybe get increased conviction, maybe you'll learn a few new nuggets that further amplifies your bull case, and you really sort of put it on. But it's a true art to have the patience to sit there and really pounce when the opportunity is right. What I have liked doing in the last number of years, when there's a really good business and they may have had a slip up, you use that opportunity to build your position. And here's a great one is Waste Connections is a garbage company all over North America. And they reported Q3 2023 earnings, and the stock was down 8%. And we're talking low volatility stock. They pick up garbage, 70%, I think, municipal work that's tied to CPI pricing. And they get 50 to 100 basis points of margin expansion every year because they tend to take price more than their costs inflate. But in Q3 23, one of their landfills smelled, and it was in California, and the residents complained. And it was getting too hot within the landfill, so it had to close it. So it was a $10 million impact to that quarter, and they didn't know when it would be, remediated. So that's the type of opportunity where you say this is and I should say it's $10 million per quarter on a $2 billion EBITDA business on an annual basis. So let's just say it's $50 to $20 million full run rate per quarter. So we're talking about $60 to $80 million on a $2 billion business. That's the type of thing that you can really get your hands around and use that as an opportune time to build that position.
EBITDA. Charlie Munger, Warren Buffett would call it bullshit earnings. Others would call it a good proxy. But what's your thoughts on it?
So, I remember being in investment banking and going to a modeling course. The first month we were there, there's big orientation, and always EBITDA is a proxy for cash flow. Mm-hmm. It's not a proxy for earnings, but cash flow. It's not perfect. I would like to see interest, come out of it.
Somebody has to pay interest.
Exactly. But it does help sort of neutralize for different capital structures that are there. We do look at earnings, like, no doubt. It's the real way to look at a business. But I would say it's a pretty good proxy to understand where things trade or, what opportunity. What we look at a lot is EBITDA less CapEx is a really good proxy for free cash if you want it. Another tool in the toolkit.
In order to have above average investment returns, you need to be unconventional, because if you're doing what the market's doing, by definition, you'll be average. How does Waratah think about that and generating returns for your clients? Where do you look?
We look all over the place. And, we often get asked, where does idea generation come from?
Yeah.
And it comes from anything. It comes from reading the newspaper. It comes from watching TV. It comes from looking at what my kids like. I love looking at your own sort of internal habits and your own personal life of what's changing. Temu. I don't know how popular it is out here in the West, but it's growing like gangbusters in Toronto and the US. And you think about, the second and third derivative of all that. Will there be an impact on dollar stores one day as a result of this? There's a whole host of things. So that's sort of idea generation. I'm not really answering your question on where, yeah. So I think a few things. We're very nimble and we tend to be creative, and we're not value investors, we're not growth investors. We'll sort of, see what opportunities are available in the market. The risk mitigation side of things is one that's, I think, quite differentiated. Again, it's in minimizing drawdowns, minimizing volatility, having a smooth ride for our client base, and, compounding wealth over the long term. If someone becomes an investor and after 6 months they're giving you a hard time about your returns, that's not it. And that's sort of not the right pairing for us. I'm a big Blue Jays fan, so I always give the baseball analogy. I say, if you want to hit a lot of home runs but strike out a lot and have a really crummy batting average, go somewhere else. But if you want to hit a lot of singles and doubles and have a high batting average and, you're okay sort of doing 10% a year, then it's sort of the perfect place.
Valuation, unless you value a company, you have no idea what it's worth. To what degree does that play into your investment strategy? Do you spend your days nuts and bolts valuing companies, or do you think more macro, or how do you approach it? Is it bottom up always, or how do you go about your
Yeah. Sadly, the macro has had way more influence in markets the last few years than, we can remember. The prior decade, I feel like we didn't have nearly as much. But you think the number one driver of stock markets last year, second half of last year, and in 22 was interest rates. And for a period of time, I feel like a couple months, I could wake up, check my Bloomberg, look what the US 10-year was doing that day. And I could tell you what stock markets were going to do that day. And I could tell you which stocks were going to be up and which stocks were going to be down. And it was clear and apparent that day. So sadly, in a perfect world, I don't ever have to think about that. And it's just finding high quality businesses to own for decades. But sadly, we do have to think about that. So I think it's a marrying of everything, which is thinking about the macro, understanding it. And then I always ask myself, when I think about the portfolio, I think, what could hurt us the most? And what type of event that happens? And we're always trying to mitigate that. So we may be we have a fairly extensive option portfolio that we put on top of our equity portfolio to hedge out left tails and right tails in the market. So I can't say, while we did well during COVID, I can't say we ever predicted COVID, but there was something in place that mitigated a material drawdown that happened. So that is sort of, if you think of three buckets that we're thinking about, we're cognizant of the macro, we're always thinking about risk and sort of what could go wrong, and then thinking about opportunities within single stocks to take advantage of in the market.
Well, that's a litany of question. Anything else you want to cover? Did buybacks, dividends, psychology of investing, utility of short selling, the natural gas trade versus oil, interest rates.
So I was going to say, I think the oil sands are grossly underappreciated from the global investment community, and we've called it the RLI trade, Reserve Life Index trade, for the last 2 years. And it's really simple. Let's all build a DCF. The longer my DCF goes on for, the more value my business is. So when I have 6 years of inventory in a shale basin, or have 30 years of inventory running the oil sands, no brainer what I would rather own today. And the fixed cost nature of these businesses and the free cash flow that gets dropped to the bottom line is spectacular, like spectacular. It only feels like the last 12 to 18 months that the US investment community and parts of the rest of the world have clued into this. but it's truly a differentiator. And I think investors will continue to come around that Canada is special. And there's a really big opportunity here.
Maybe just to wrap up the podcast, if you were to give advice to the common investor out there, maybe to touch on themes, this isn't a financial advice podcast, but what direction would you point them in?
There's a lot of money to be made in themes and finding the winners of that theme. And I'll come back to that in a sec. But I get a lot of students or new grads or new people to the finance workforce that, want to come work for us and want to connect. And they always ask for advice. And the piece I always give them is be inquisitive. Always ask questions. And it's not just stock went up. Why did it go up? Why did a business make the acquisition they did? What problem did it solve? And to me, it's always the why, and it's often overlooked by investors, and there's not enough attention or detail posed to it. Like, it's management teams and boards are very strategic in the in decisions they make, and whether or not you play in a long chess game, which I'd argue Mike Rose is, and we are only 3 steps into his 53-step plan. And we'll in 5 years find out what that all looks like. But it's the why, and that would be it. And coming back to themes, like so we haven't touched upon it, but we run a long short ESG fund, and it's not a renewables fund. It's not a green fund. This is what opportunities from changes in the world are available to sort of get behind. And it's not just decarbonization and so forth. It's, and here are a couple themes that we think of all the time is nuclear is basically a zero emission way of producing hydro power for the world. So that's number one. Number two is natural gas is half the emission profile as coal. So why wouldn't I invest in Canadian natural gas producers to send gas off the West Coast Canada, to ship it to Asia, to displace coal-fired power generation in Asia? And it's a massive win for the world. Shipping a good on a railway is 4 times more efficient than shipping it on a truck. Does rail steal market share from trucks over time? 30% of a company's GHG emissions are from the real estate portfolio. So are they going to look to upgrade their HVAC system? Where are the HVAC players? Well, there's 4 big players, one of which is predominantly residential, 3 of which have a pretty meaningful commercial operation. I think it's those type of things that you think about and you go down the path and you can find the winners and you can find the losers. And it's really powerful to think about. And it's not something we play, but to think, if you think through 2023 and how powerful the AI narrative was and what that did to select stocks, it's a perfect example of what, the market can do. Usually overshoots to the upside. Mm-hmm. But there certainly are true earnings winners that come out of real themes.
Wow, that's awesome. I think that's a good summary of a broad array of subjects. We know that a listener will really appreciate your perspective. So thank you.
Thanks for having me. Appreciate it.
We can end the formal conversation there. Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.